Welcome to The Deep Dives, the show that extracts the critical insights you need from the latest earnings calls. Today, we're dissecting Hayward Holdings' second quarter 2025 results. This call definitely had the market buzzing, and, well, for good reason. How is the company managing to, not just stay afloat, but actually deliver standout record-breaking results in what's still a pretty challenging economic environment? That's really our central question today.
Exactly. Hayward delivered a truly robust quarter. Showcasing impressive financial discipline and strategic execution. The market certainly took notice. You saw that positive stock reaction, and you should too, because we're here to unpack exactly what made this earnings call, well, kind of a masterclass in operational excellence and proactive strategy.
Okay, so let's kick things off with a quick look at the headline numbers, the ones that caught everyone's attention. Hayward reported a significant beat on both EPS and revenue for Q2. But what makes these particular numbers not just good, but, truly stand out compared to peers or even Hayward's own history?
Well, yeah, looking at the raw figures, their non-GAAP adjusted EPS came in at $0.24. That comfortably surpassed the $1.22 to $1.23 consensus. And for those listening, non-GAAP adjusted EPS, it's a key metric, right? It gives you a clearer picture of their core operational profitability. It strips out one-time charges or unusual items, so you get a truer look at how well the business is actually performing day to day.
Right, the core performance.
Exactly. And revenue also exceeded expectations, hitting $299.6 million against an anticipated $289 million to $291 million. So solid top and bottom line beats. Shows they can exceed Wall Street's expectations.
What really jumped off the page for me, beyond just the beats, were those margins.
Absolutely. And this is where the story gets really compelling. They achieved a record consolidated gross margin of 52.7%. That marks their 10th consecutive quarter of year-over-year expansion.
10th quarter. Wow.
Yeah. 170 basis point increase year over year, that's 1.7 percentage points, which is a truly impressive leap, especially given the current cost pressures lots of businesses are facing. Adjusted EBITDA, another measure of core profitability, was strong at $88.2 million. And critically, their net leverage dropped to 2.1 times.
Okay, 2.1 times. What does that actually signal?
Well, it means their total debt is now just over twice their annual adjusted earnings. So it indicates significantly improved financial flexibility and reduced risk. These figures together, they paint a picture of impressive operational excellence and financial health that really stands out in today's market.
Okay, let's unpack this then. Get into the nitty-gritty of how Hayward actually achieved these impressive results. Starting with revenue drivers, what was really pushing that top-line growth, especially with consumer spending maybe tightening in some areas?
Right, so that 5% increase in net sales was primarily driven by two key things. First, a 5% positive net price realization, which frankly is a testament to their strong brand and pricing power in the market. They've managed to pass on some cost increases without seriously hurting demand.
Okay, so pricing power is strong.
Yeah. And second, a 2% contribution from their ChlorKing acquisition, which closed back in June 2024. Now, this was partially offset by a 2% decrease in overall volume, so that does suggest some, softness in maybe more discretionary purchases.
Makes sense.
Geographically, North America led the charge, sales up a strong 6%, but even their Europe and rest of world segments saw a 3% increase, so the growth wasn't just confined to one region.
So top-line growth, impressive. But maybe even more striking, and perhaps more indicative of their underlying strength, is how they've managed profitability. Let's talk about those record gross margins again. How did they wring such impressive margins out of this environment, especially when, so many are struggling with inflation?
Yeah, that record, 52.7% consolidated gross margin. Like you said, it's a multifaceted achievement. Management highlighted aggressive execution on tariff mitigation plans. We can dig into that more, along with significant productivity gains within their operations.
Okay.
They're also strategically rationalizing their product lines. Basically, that means they're shedding lower volume, lower margin SKUs, those individual product codes, while introducing higher value, more profitable products.
Smart move. Optimizing the mix.
Exactly. It's about optimizing that product mix. Plus, they benefited from improved capacity utilization during the quarter, so essentially making more efficient use of their existing factories. And North America's gross margin was particularly strong, up 220 basis points to 55.1%. That points to really solid domestic performance.
And a huge part of achieving those margins, as you mentioned, has been dealing proactively with external challenges. Tariffs, especially, have been a major headwind for so many companies. How exactly is Hayward navigating that landscape so effectively? It almost seems like they're turning it into an advantage
Hayward's tariff mitigation strategy is really a textbook example of proactive management. And frankly, it's a key differentiator for them. They've significantly reduced their estimated annualized tariff impact. Think about this. From around $85 million down to roughly $30 million.
Oh, that's a big drop.
Huge. With about $18 million projected for the full fiscal year 2025. How'd they do it? Primarily through a 3% tariff-related price increase in North America back in April. And crucially, an aggressive pivot to reduce direct sourcing from China.
Okay, the reshoring piece.
Exactly. They're aiming to get that down to approximately 3% of their cost of goods sold, the direct cost to make their products, by the end of 2025. That's a sharp decrease from roughly 10% just recently.
That is a pretty aggressive reshoring effort.
Yeah.
You mentioned they determined the cost differential between China and U.S. manufacturing is now de minimis enough. Can you unpack that a bit? What makes it de minimis enough now?
Yeah, it's not just about dodging current tariffs. This is a fundamental strategic shift. They've basically found that the cost difference between making things in China versus the U.S. has become, negligible for them in many cases.
Interesting.
And this isn't just about today's tariffs. It fundamentally de-risks their entire supply chain from, broader geopolitical shifts, potential future trade issues, even transport costs. By bringing production closer to home, they get much greater control over quality, lead times, inventory.
Brand control.
Which could give them a significant long-term competitive advantage, one that maybe others in their industry haven't fully committed to yet. It positions them as a more resilient, more agile supplier.
That's a powerful point about de-risking the supply chain. So what does this all mean for their core business segments? We know the aftermarket is huge for Hayward, but they've also been making big moves in commercial.
Right, the aftermarket. It remains the resilient backbone of their business. We're talking roughly 85% of total sales. Think of it like the steady hum of a utility. It's non-discretionary maintenance demand, filters, pumps, heaters that have to be replaced. That continues to hold strong and provides incredible stability.
Yeah, that baseline is key.
Absolutely. But on the flip side, they've seen really significant success in their commercial pool business, largely thanks to that ChlorKing acquisition last year. They said the integration has been very successful, basically doubling North American commercial sales year to date.
Doubling.
Yeah.
Oh.
And management's aiming for this segment to become a double-digit chunk of their overall mix in the medium term. So that provides a substantial organic growth lever for the company, likely in a higher margin category too.
Okay, and you touched on innovation. Beyond just mentioning SmartPad and OmniX, what's the real game changer here? How do these products actually transform the experience for pool owners, and what kind of competitive edge does it give Hayward?
Yeah, these aren't just, minor updates. They're strategic moves into the whole smart home ecosystem, but for pools. SmartPad and the new OmniX automation system, they're designed specifically for the aftermarket to increase the equipment content per pool pad.
More stuff on each pool setup, basically.
Exactly. They're selling more smart devices, more connected equipment for each pool. For consumers, this means easier management, better energy efficiency, a more kind of seamless pool experience. And for Hayward, it builds a powerful competitive moat. It locks customers into their ecosystem, provides higher margin products, and lets them leverage data to inform future innovations.
Right, the ecosystem to lock in.
And they're backing this up. They're making targeted SG&A investments that's selling, general and administrative costs and advanced engineering, new product development, customer care, sales, and marketing. The goal is driving SG&A as a percentage of sales down into the lower 20s in the medium term. It shows a clear commitment to future growth, market share gains, staying ahead on the tech front.
Okay, makes sense. And what about the broader market for pools? Especially new construction and remodeling. Those are generally more discretionary areas, right? And you mentioned this idea of a coiled spring effect. Can we unpack that? What are the specific macroeconomic triggers Hayward is sort of banking on? Is there historical precedent for a strong rebound like that in this market?
That's right. New pool construction, it definitely remains pressured, primarily by higher interest rates, which impact financing costs for homeowners, and just general tariff noise affecting consumer confidence. However, management believes the market is near trough levels. They compared it to post-GFC figures, but noted higher home values now, and migration trends to warmer areas could make the base stronger.
So pent-up demand, basically.
Exactly. The coiled spring analogy suggests significant pent-up demand. Hayward's banking on, well, a moderation in interest rates and just a general improvement in the housing market to unleash it. Historically, discretionary spending on big-ticket items like pools, it does tend to rebound sharply once economic uncertainty eases. People feel more confident investing in their homes. They're also seeing a trend of increased parts sales, which suggests customers are opting to repair rather than fully replace equipment, especially expensive things like pump motors.
Keeping the old one going longer.
Right. And remodel demand is also tempered. It's discretionary, but the average installed pool is around 24 years old, so there's a natural limit to how long people can put off those bigger renovation projects.
Right. Things eventually break.
Yeah.
Now, Hayward's balance sheet, you said, is looking quite healthy with that deleveraging. Net leverage lowest in over 3 years. How are they planning to deploy that financial flexibility? Any specific types of M&A bolt-ons that look particularly attractive right now?
Yeah, their capital allocation strategy seems pretty disciplined and clear. Top priority, funding organic growth. That includes new product development and, importantly, those further investments in reshoring production with automation.
Okay, investing in themselves first.
Right. Second, M&A remains a core focus. When they talk about a healthy pipeline, what are they looking at? Probably residential bolt-ons, maybe smaller regional players to expand footprint or product lines, and commercial expansion opportunities like ChlorKing, which significantly boosted them in a high-growth segment. You could imagine them maybe acquiring a specialized pool chemicals company or a regional commercial service provider.
Got it.
And finally, they're committed to returning capital to shareholders, evidenced by that newly authorized $450 million share repurchase program over the next 3 years. It really speaks to a balanced approach. Invest in the business, grow through acquisitions, and reward shareholders, driving long-term value.
Let's talk guidance then. With all this positive news, strong performance, what's their outlook for the rest of FY 2025? Any caveats or assumptions in that guidance we should be aware of?
Yeah, they refined their FY 2025 guidance. They raised the low end of their net sales range, now looking at $1.070 billion to $1.100 billion. That would be an increase of 2% to 5% year over year.
Okay, tightened and raised the bottom.
Exactly. Adjusted EBITDA guidance was maintained at $280 million to $290 million. And they expect about $150 million in free cash flow. That represents over 100% conversion of net income, which basically means they're turning every dollar of profit into more than a dollar of usable cash. Very strong sign of financial health, efficient operations.
Very efficient.
Now, the updated guidance assumes a slightly lower net price contribution, at least 4% compared to what they thought before, but also a stronger volume performance, now projecting only a 1% decrease rather than the previous 2.5% drop.
Interesting trade-off there. Less price, better volume.
Yeah, and it's really important to note this guidance does not factor in any potential new tariffs that might kick in after July 27th, though the company did state they are prepared for mitigation if needed.
Okay, that's a key caveat. So what should investors be watching for then? Key catalysts moving forward. What would really drive the stock's reaction, do you think?
I think key catalysts include, obviously, the upcoming Q3 earnings print for further guidance, updates, and insights. Also, any moderation or extension of current tariff impacts. That could be a tailwind or a headwind, depending on how it plays out.
Right, the tariff situation is still fluid.
Definitely. We'll also be watching commercialization milestones from ChlorKing, seeing how that integration continues to deliver and continued progress on those SmartPad and OmniX product launches. How quickly do those ramp? Ultimately, I think the stock's reaction is expected to track pricing durability and those tariff offsets more closely than just pure unit volume growth.
Makes sense, given the margin focus.
Exactly. Despite some macro uncertainties out there, management's confident tone around their strategic execution and profitability drivers, it seems pretty well-founded. And it aligns with that positive market reaction we saw after the call.
All right, it's time for our This Is Not Financial Advice segment, where we throw out some outrageous but plausible trade ideas based on today's deep dive. And remember, folks, this is purely for entertainment, conceptual exploration. Always do your own rigorous due diligence.
Okay, well, given Hayward's Q2 performance and everything we've discussed, I'm pitching a conviction long on HAYW. My thinking here centers on the company's exceptional execution, particularly in tariff mitigation and their proactive reshoring efforts. I mean, that pivot to reduce China sourcing to just 3% of COGS by end of 2025, that, combined with their ability to maintain price-cost neutrality even with inflation, It indicates a management team that can just navigate complex supply chain dynamics better than most.
Real operational edge.
Yeah, it provides a clear, defensible path to sustained record gross margins that I think competitors will struggle to match. Furthermore, that strong, maybe often underappreciated growth in their commercial segment, doubling North American sales year to date with ChlorKing, aiming for double-digit mix that offers a substantial and relatively stable organic growth lever.
Okay, so strong margins, commercial growth.
Right. Couple that with a balance sheet at its lowest net leverage in 3 years, plus new $450 million share buyback authorization. Hayward seems powerfully positioned to compound value for shareholders. Now, the outrageous but plausible part, I'd suggest a long position in HAYW with a medium-term target that, let's say, significantly surpasses current analyst price target.
Okay, going beyond the consensus. Why?
Leveraging the belief that the coiled spring effect in new pool builds, while it's a watch item now, presents really substantial upside optionality. If interest rates ease sooner or maybe more significantly than the consensus expects, that pent-up demand could just unleash a wave of new construction that would turbocharge an already robust, strategically agile business.
So the base case is strong, but there's this potential kicker from rates and housing.
Precisely. The market has started to appreciate their execution, but I believe there's much more runway given their demonstrated operational excellence and strategic foresight.
That was a truly insightful deep dive into Hayward Holdings Q2 FY 2025 earnings. From those record gross margins driven by smart product mix, tariff mitigation to exciting commercial growth, and that strong balance sheet. The company clearly demonstrated its ability to execute, maybe even thrive, in a tough environment.
Indeed. Their disciplined capital allocation, combined with the resilience of that aftermarket base and strong leadership, it positions them well for future value creation. Even as they carefully navigate the more, discretionary parts of the pool market, it definitely leaves you wondering just how much further can they push those margins? And how quickly will that new pool build coiled spring actually unwind if the macroeconomic winds shift? The implications for other industries facing similar challenges are also pretty fascinating to think about.
A great question to ponder. Thank you for tuning into the deep dive. Remember, the insights shared here are for informational purposes only and definitely not financial advice. We encourage you to consult with a qualified financial professional before making any investment decisions. We look forward to bringing you more deep dives into the world of earnings calls soon.